What's up, everyone? Thanks for joining me on these analysis. Today we're going to be looking at a dividend growth portfolio geared for retirement but still gaining growth. So you're going to have VUG at about 30%, JEPQ 35, and JEPI 35. So these are income ETFs. They're pretty good for whenever there's some kind of drawdown. They have solid companies that issue out pretty solid dividends, and they pay out pretty high dividends, and they yield part of their dividend off of covered call options. That's how they're able to get such high premiums. So we're going to look over this portfolio. Here's the allocations again. We're going to go to the settings. I put 500,000 because this is for a retirement account. So it wouldn't make sense for me to put $20,000 or 100,000. So I put $500,000. We won't be reinvesting dividends, so you'd be living off of it in this scenario. We're going to display the income, and then we're going to analyze portfolio and see what we have. So again, this is the allocation. 70% is in JEPI and JEPQ. So your starting balance was 500,000 and you finished with 709,000. By the way, we started January 2023 to February 2025 because that's as far as the data goes back, because JEPQ is pretty new. But just in this 2-year sample, you can see what happened. 500K turned into 709. Your CAGR is 17.53. That's the compound annual growth rate. And your max drawdown was 7%, which is not bad, especially in a retirement portfolio where you don't want your money fluctuating too much because you're retired. And you can see here what it actually looks like on a scale. You hit $600,000 within a couple months, get a little drawdown, pick it back up, and you peaked at 720,000 at one point, which is amazing. You can see your returns versus the S&P 500. So you gained 30% and then 22% against the S&P 500. And this is your income, $37,000, $37,500 in 2023, $40,000 in 2024, and then you're just starting out in 2025. But as you can see, you're getting solid growth, a solid dividend, and not much drawdown. Granted, we don't have a massive data set, but what I can do to kind of get an idea is we can do JEPI, which has been around for a little bit longer. So we can do 70%. JEPI is a little bit less volatile than JEPQ because JEPQ is the same thing as JEPI, but in the NASDAQ. So the returns are going to be a little bit lower. So you're at 620,000. Max drawdown 20%. And I believe that was in 2022. So you can see the returns. 23, negative 12, 21, 18, and so on. And the reason you have negative 12 is because you have VUG, so there's a little bit of growth in there, so there's more volatility. And then you can see your portfolio growth, 27,000, 42. You had that drawdown, so your portfolio dropped a little bit, back to 29, and then about 30,000 here. So it's a pretty good way to make a good income and grow your portfolio. And this is only really 4-year sample. You can't really count 2025. So you can see that your money's growing, but you're also getting a pretty solid dividend. So it's a good way to live off this money, especially, if you're talking about $1 million and so on, if you've been consistent with dollar cost averaging over the course of years. So we're going to take a look at the charts, and you can see JEPQ has been on a tear since 2022. We just broke this trend line. We broke it once and shot back up. We just broke it right now. So let's see what the next move would be. We just fell below the 50 SMA on the weekly, and we're underneath the 20 and the 50 on the daily. So that doesn't look too good for JEPQ at the moment, but it's a long-term hold, so it's nothing you'd be concerned about. You just want to be honestly buying. If you're in these funds, you want to be buying these dips for the long term. So JEPI, we're right at the 50-week moving average. So see if we get a bounce off of that. Been riding up this trend line. But JEPI is a very, very solid option. It only lost negative 3% in 2022, while the rest of the stock market dropped 20 to 40% that year. So JEPI is a little less volatile than the other options. It gives you a steady income, minimal growth, but that's why you're supplementing it with VUG and JEPQ. So And then VUG, which is the big dog, a lot of growth, very aggressive. This is what we have here. So as you can see, we're still above the 50 right now, the 50 week. So maybe we get a bounce here. If we break through, that could take us much lower. But kind of have a level here, something in this region, somewhere around here, yeah, something like that. So maybe we get a bounce here, maybe chop a little bit, and then get our way up. So we'll see how that goes. Also gonna vary based off that unemployment data that's coming out tomorrow morning. I believe it's at 8:30 if I'm not mistaken. So we'll see how that goes. But yeah, I mean, I think that's a good option for somebody that's a little more aggressive in their retirement, but they still want to be safe and get a solid income. I think that's a great option. So you can still grow your money and your money's not stagnant, but you're also getting a pretty solid dividend. Because that's the balance. You're trying to find that balance in retirement. So you want a bunch of growth and no dividend, and then take a 4%, like do the 4% rule, and you withdraw money. Which I think you can actually do a little bit more than 4%. I've seen some things where they're kind of like busting the 4% myth. You can probably go up to like 5%, depending on your portfolio allocation. But then you have the other option where you can do the dividend route, so you don't have to do any withdrawals, and you can do things like JEPI, JEPQ. JEPI gives you a 7.14 dividend, while JEPQ gives you a 9.9, and then you get a small, like a 0.5 or 0.2 from VUG because it's primarily a growth ETF. But I think those are solid options in retirement, especially a JEPI, JEPQ. If you really don't care about your money moving at all, you could just put it all in JEPI, and maybe even SCHD, those two combined, and just relax. You don't have to worry about anything. Just continue to buy if you have leftover money and stack it up, and your dividends will just continue to increase. And if you have it reinvesting, then even better. You're just buying more shares with the money that the stock is giving you for holding it, or ETF is giving you for holding it. So that's all I have for you guys today. Let me know down in the comments section below what your retirement plans are and what you guys think is the best option, and I'll see you in the next one.